Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's July the 26th, 2017. In today's video, I want to talk to three issues. First of all, proposed tax changes here in Canada at the federal level. Number two, the Canadian dollar, which I don't have to tell you has been appreciating vis-a-vis the US dollar this year. And then thirdly, just a quick note about stock certificates. Okay, so let's turn our attention to tax policy. Recently, the government tabled some proposed changes to tax policy. And on a slide that's going to go up here, I'm going to use slides to walk through here because of the detail. This will be easier for you to follow. On the first slide, let me just walk through that slide with you. The federal government had released a discussion paper, contains draft legislation and proposed measures that will significantly restrict what are now commonly used tax strategies for business owners and also professionals. The proposed measures include a punitive tax on dividends to certain shareholders, which basically means within these corporate structures it's going to limit family income splitting. It's also going to, at least the proposed change, is elimination of the ability to multiply the capital gains exemption on the sale of small business corporations. And it also introduces another set of complex rules in order to eliminate the benefit of using after-tax corporate money in the corporation for active investings. So that's on the slide one. Now, if you turn to slide two, which is going to go up on the screen there in front of you, now, and I'll walk you through why I think these proposed changes are not just, are not fair, but it is important that there is a window here in order to address some of these issues and write your MP and make comments to the government prior to October 2nd, 2017. That's what's on that slide too there. It's important, I think, for all of you to write government. As I say here, when will Canadians stand up against the abusive, and I mean abusive, tax policies of our various governments, and that includes, provincial and federal governments? How much is enough for these rapacious governments to take? We should be outraged at the depth of taxes in this country. And virtually 45-50% of the economy is almost as subsumed in taxes when you add up all of the taxes in this country. And you're not going to grow a productive economy with the government taking that much in tax. Now, on the third slide, which is going to go up on the screen there right now, on the third slide, what I've done here, and I've borrowed this from a tax consultant, is, you see, I've compared what some of the executive benefits with business owner benefits. You see, part of the reason why business owners and professionals were given a little bit more tax flexibility wasn't that they could avoid taxes. It wasn't because it was just some loophole. It was because they take greater risks, and there's other benefits that an entrepreneur or a business owner doesn't have vis-a-vis an executive in a large corporation. And so the government in the past tried to acknowledge that and make adjustments for it so that they would have some tax benefits. I mean, they're not huge tax benefits, but they would allow some tax benefits and greater flexibility. So on slides 4, 5, and 6, I actually go through some of the challenges that business owners, small business owners, and professionals have vis-a-vis, highly paid executives, and why some of these tax incentives are important and actually are fair. And this is something that our current government, just doesn't seem to understand. So what are some of the differences? And let me go through these quickly. Number one, small business owners and professionals must pay for their own health benefits from their own profits. Many executives have that benefit built into their remuneration package. Number two, the business owner doesn't receive paid vacation. As you know, if you're a business owner or you're a doctor or professional, you aren't there, you're not paid. 3, the business owner does not have a pension provided by the company. And this is important also. I mean, basically, you have to pay your own way. On slide 5, I list points number 4, 5, and 6. These are other differences between, again, top corporate executives and small business owners and professionals that have been able to use a corporate structure to try to minimize some taxes. Number 4, if the business owner needs to take time off, the birth of a child, maternity benefits, they don't have a company that tops up that benefit, which often happens for top executives. No, they forego it. Ultimately it's coming out of their pocket, so they don't have that type of benefit. Number 5, if the business owner has to declare bankruptcy, the business owner doesn't receive severance, doesn't receive unemployment benefits or employment benefits, depending on what you want to refer to it as. You just go broke. That's it. You're bankrupt. You're out of business. You don't get a year or year and a half paid severance like executives often do. They're golden parachutes. You're out of luck. And then the 6th point that I think is important is the business owner provides their own startup capital and must find their own source of capital. And they put much more risk on the table early on as they start their business. And in fact, many small businesses fail. So these are some of the differences. On the last slide there, the next slide I should say, slide 6, I provide a couple of more points that are important, points 7, 8, and 9. And that is that the business owner, if successful, creates wealth and a tax base for the community along with employment, which is not the case necessarily for just an executive going into a position in a large company. Small businesses are the ones that create most of the new employment in Canada. Number 8, small and professional businesses remain the most creative and entrepreneurial when it comes to creating new products, innovative technologies, and overall productive advances in the economy. They're very important engines of growth. And then the last point, hardworking people and business people produce wealth. The government does not create wealth. Taxation levels in Canada are off the charts, and the government's attitude is that all wealth really is theirs, and aren't they being nice and gracious and kind and letting you keep a little bit of your money? And that whole attitude, we as Canadians should be outraged at, especially business people, and we need to start pushing back and saying, how much is enough? So those are some points I think, again, we need to address them. You need to write your MP. You need to get up to speed on some of these issues. Taxation in Canada is absolutely out of control, and we need to start speaking up. The second issue I want to talk about just very quickly is just the Canadian dollar. Whenever the Canadian dollar goes up a lot, all of our clients, not all of our clients, but many of our clients will say, what's going on? So let me just make a couple of points here in terms of the Canadian dollar, and I have a slide that has gone up just that summarizes a few points here. First of all, we don't predict currency moves, nor do we try to make short-term profits based upon currency changes. Number 2, year to date, the Canadian dollar is up about 7% against the US dollar, and we invest heavily in the US and buy international assets. So this puts a lower value on our US holdings, as you know. So you'll see, value of the US holdings come down as our Canadian dollar goes up. It doesn't change the long-term values of these businesses, and that's my point and what I want to emphasize. These are just short-term ticker prices that we're seeing based upon currency moves. Number 3, we will actually use the upward move in the Canadian dollar to buy more foreign assets at better prices. It gives us greater firepower, greater purchasing power. And so we're going to use that to your advantage. And then 4th, just try to ignore short-term currency changes. Stay focused on the long-term fundamentals of the businesses you own. The quality of the companies and their long-term prospects are more important than currency changes. And so I just want to point that out to all of our clients. We don't suspect our dollar is going to go up an awful lot higher than it is now. It certainly shouldn't, but currencies can surprise, especially over short periods of time, and so we remain flexible. The last point that I want to just address quickly is this issue of stock certs. And this is a big area, but I just want to make a couple of quick points. We had a client come in with some stock certificates, and it turned out that these certs had gone dormant. And in their dormancy, there had been some challenges in terms of recouping the full value of those certs. So let me just make a couple of comments about stock certificates, if you have them. If you have a share certificate, Make sure, number one, and this is on the slide that's just up on your screen here, make sure you stay in contact with the transfer agent listed on the stock certificate. You need to keep in contact with them as they send out different correspondences to you. Maybe they send out dividend checks. If you're receiving dividends, they let you know if the stock's been split. But you have to stay in correspondence and make sure they have your address and can contact you. Why? Because if they lose contact with you for 3 years, 5 years, it's going to depend on jurisdiction. You can enter a period of dormancy, and this is what happened with one of our clients. Their share certificates became dormant. They lost contact with their transfer agent. And what happened is the shares actually got sold, and the value of the shares was being held at the state in the United States where the head office was actually located of the business. So in this case, it was Apple shares, and therefore they're based in California. And California decided that they would sell the Apple shares and just hold them in perpetuity in case they are claimed later on. But what happened is, of course, our client did not get the upside, all of the upside in the Apple stock because of that transaction. We were able to go and then try to get that money, the value back, at least a portion of the value back for our client. In Canada, some of the dormancy laws mean that after a period of time, the shares can be sold and actually given to the province. And so there's a whole host of laws around this that are quite complex and depend on whether your citizenship and what country you're dealing with and so forth. My point is this: if you have a stock share certificate, make sure you're in contact with the transfer agents that's listed on the cert and you have an ongoing relationship with them. If you haven't had contact with the transfer agent and you have a cert, get on the horn right now, phone them, email them, contact them, and make sure you keep up to speed with them so that your share certificates don't go into a period of dormancy and you risk losing either all of the value or a portion of the value of those certs. Okay? Anyway, so I hope that's a helpful update. Please write your MP about the tax changes. Please speak out about the level of taxation in Canada to our elected representatives. We've got to start pushing back here. Okay, so if you have any other questions about your portfolios, investments, just let us know, and I trust you are all enjoying the summer. Thank you very much. Bye now.